folks, Wedell here. I'm the Chief Investment Officer at RFG Advisory. I thought I would come to you today briefly with a market update. I don't do a whole lot of market updates when I'm on the road traveling, but today I am down in our Naples office. And I just thought, given the volatility that we closed out with last week and the volatility that we're kind of opening up with this week, that it would be wise to get out there and just sort of let you know what's going on. The S&P 500, as I speak, is currently flirting with about 4,000 as a level. That is obviously off a little bit since the last time we spoke. And I think when we get in these times of market volatility, it's really important to keep perspective on about three different things. The first is to keep perspective on sort of the long-term returns associated with the market as opposed to focusing on what's happened in the past couple of months. We all talk about being long-term investors. We talk about investing for the next 5, 10, 15, 20 years. And it sometimes can be a little easy to forget, what that actually means and the fact that the market's cyclical and goes through these ups and down motions. So I thought it would be a good idea to just remind people where we've come from. If you look at the S&P 500, and I'm talking about annualized returns, so if you look at those annualized returns since the beginning of 2021, so for about a 17-month period, a little over a 17-month period, then we've had about a 7% annualized return over that time period. So, and that includes all of the sell-off that we've had this year, so not too bad. If you actually take that number back to the beginning of 2020, so look at about a 2.5-year return period, once again annualized, we've gotten about an 11% return. And if you actually take that number back to the beginning of 2019, so at a 3.5-year time frame, we've had about a 16% annualized return. So I just want that to sink in, even with the sell-off we've had. If you look at equity returns over the past, 2.5 years, you're looking at between an 11. If you look back at 3.5 years, you're looking at about a 16% return per year for the equity market, which is still very, very strong. And we talk about equity markets having about a 10% per year return, plus or minus. And that sounds very smooth, and obviously we'd like it to be very smooth, but the reality is that it looks a lot like this. We get choppy years where we're up 25, 30%, followed by years where we're down maybe 10, 12%, followed by years where we're up again. And it's really, it's a volatile journey, but it's a journey that we have to take as we're looking to save, over the course of being, a long-term investor. The second thing that I think is actually important to have perspective about, particularly for this market sell-off, is we're dealing with a valuation-driven sell-off. The market is struggling with what is the appropriate earnings multiple to pay for the S&P 500 or for any stock in an environment with 3% long-term interest rates as opposed to 1% long-term interest rates. And that's a challenge that creates a little bit of a valuation sell-off. It creates a little bit of a hesitation to own stocks at some of these higher multiples relative to what you can get in the fixed income markets. What we do not have is the type of recessionary contraction in GDP that we see in some of the more painful cycles throughout history. So unemployment rate's still at about 3.5%. GDP grew at 6% plus actually in the fourth quarter of 2021. We have corporate earnings. We just finished up basically first quarter earnings season. Revenue was up 14% for the S&P 500 and earnings were up 6.5%. These aren't numbers that you typically see in a recession when the economy is weak. In fact, the economy, if anything, is too strong. The Fed is putting on the brakes to try and contain inflation, and that inflation has been driven by sort of runaway demand relative to what industry can supply. It's a good problem to have, not that it's not a problem, but we'd much rather have that problem than have a problem of demand that's sort of falling off a cliff as unemployment starts to spike and companies start to shut down on the other side of the business cycle. So just keep in mind, frame up that this is really a valuation issue, not necessarily a corporate earnings issue. And then last but not least, I think it's important to have perspective on what you do about it. I was talking with a client today who said that, someone that she knew recently told her that, this weekend or over the weekend had told her that they were going to sell out of their entire equity portfolio today. And I just, I wish I could reach out and touch this person if, kind of talk to them about the fact that market timing in this fashion is inherently dangerous, right? The S&P 500 is down 12, 13% for the year. You've obviously missed that drop. So you didn't time it correctly on the exit. I don't know how much further you think we have to go, but, you obviously missed the first 12, 13, 14% of it. And then the worry on the other side of it is obviously, how do I get back in? Or when do I time when to get back into the market? Because if you're wrong by a similar magnitude on the other side of it, in other words, if the markets actually rise off the bottom by 10, 12% before you actually catch it, you've created for yourself a 24% headwind, 25, 30% headwind, where you didn't necessarily need to. And I just ask everybody to keep in mind that the average, full recession downturn is about 30%. So by, trying to time the market, if you don't get it exactly right on the entry and exit, you may cost yourself more than if you just rode the thing out to begin with. So with that, as always, if you have any questions, please feel free to reach out to either myself or your advisor. I hope you're having a great day, and I look forward to talking to you again soon.
Thank you for tuning in. And if you're enjoying this content, please subscribe to our YouTube channel and click the bell to be notified when we post more.